In this video, traders, we're going to look at 4 time-tested market bottom patterns. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me on this video. Okay, so this video is sponsored by Core Spreads Australia. There's a link to them in the description below. Hit the link and go and check them out for all your spread trading. Wide variety of markets, super tight spreads, nice platform. Go have a look, link in the description below. Anyway, 4 market bottom patterns that are time tested, guys. Some with the great traders from years ago, some of the old kind of manuscript type books talk about these type of patterns. Now, these are quite broad, but some of them will go into a little bit more detail. So basically you'll find that majority of market bottoms fit into a lot of these categories. You might be slightly different, and no 2 market bottoms ever the same, right? But generally speaking, if you have these main ones down, you're at least going to be familiar when markets start turning. Now, when I talk about market bottoms, we are talking from medium term, long term, intraday. The price patterns are all very similar. Some different nuances when you go up the higher time frames and on the lower time frames. But the point is, you can be talking about an intraday reversal, a market bottom intraday. You can be talking about a market bottom over the quarter, or even a longer term market bottom after a kind of bear market. So very, very flexible, very useful to have these in your trading arsenal. So let's get right to it. The first one, guys, is the classical double bottom, but there's a certain few things that we like to see on this. Now, the double bottom, for those of you familiar, is literally a test to a low. So a low is printed in, and then a second test to that same low that finds support and bounces off there. So if we were looking, let's go this side, if we were looking at the drive lower here, finds the level here, there's your first tag, comes down, tags it again and pushes back off. That's your classical double bottom. However, there's slight nuances that we like to see when we're trading this, because most of the time, guys, the textbooks tell you that it comes down, it bounces off that support right to the tick. Life's not like that. There's going to be most of the time a little test through, especially nowadays with the algos, and depending on what market you're trading. If you're trading kind of the DAX, if you're trading some of these more crude oil DAX, gold, those kind of things that have a little bit less liquidity in the order book, when they start to go through those levels, the whole world has their sell stops under there, and you get a cascade of liquidity that causes a complete kind of wipeout of all the bids, and that's where you get often a little test below. Now, this is what we like to see, because if we see a second test that just goes under, let me take that off because that might be confusing. If we get a second test that goes under that first level which was there and then pushes back up, that's still our double bottom. We're just getting a little short-term test lower. Now, that on a daily chart, that could be a wick on a candle. Intraday chart, it might be 4 or 5 minutes, 6, 7, 15 minutes before it pushes back up, depending on the time frame you're looking at. The point is, we're still in double bottom territory. In other words, if that level was 50, that might go to 48 or something of that order of magnitude and then come straight back up. Now, if we see that, it's a classical double bottom trade, we can consider leveraging on that low and perhaps taking a long trade as we push back up and close above that low, and using the intraday low as our final stop. If we're going to lower time frames like a 15-minute chart, then we do that on a 15-minute chart or a 5 or whatever is the chart frame time frame that you're looking at. So that allows us to quantify the risk a little bit. We can put a stop in an obvious place, and if it comes back and retests, no big deal. We get stopped out as long as our risk is managed. We can take these all day, every day, because if it is true market bottom, you're going to get a good risk-reward ratio as the market starts to reverse off that low. So classical double bottom, guys, variations of that. Sometimes you might find it doesn't quite test that level. Sometimes you might find it tests it a little bit. Sometimes it goes through quite a lot intraday but comes back, so it looks like a long wick. All sorts of little variations. But the double bottom, even though it's talked about loads in the textbooks, super popular, is still very, very powerful. Right, number 2, guys, exhaustion. This is a nice one. You get a downtrend, you get kind of a big strong downtrend, and then finally you get a crescendo of selling. So if we're looking at a daily chart, daily time frame here, daily candle would be a good range of candles, kind of longer than normal. You'd have good volume on that if you were tracking the volume, and you'd also have some kind of reversal. So in other words, when you go down and test that low, you want to come back. Now, we're not saying we're always doing a V-shaped bottom kind of like this. We're talking that very often we come off at least that extreme low. So if we looked at just this candle exhaustion pushing candle or bar in this case, the extreme move, the high volume, what we don't want is to be closing at lows. We don't want it to be a solid red candle. We don't want it to be a solid bar. We want it to at least have come back off a little bit, or the next day come back off or something. We don't want to see it accepting price. That's the point. Otherwise, it's not exhaustion. So criteria, good range, good volume, and a little bit of a reversal, and then we can kind of see perhaps if it closes near to highs, great, we've got a good place to put our stop loss. We can start to take a buy position here, we can have a stop under there, we can take our buy spread bet, our stop under there, or buy whatever market we're trading, whatever kind of asset class we're trading. Take the buy, put our stop under there, and it starts to push up. If it doesn't, comes back down again, the risk order ratio is not too bad on this. And if you learn to spot these, a little bit rarer than some of the others, but worth having and be aware of. Okay, so the test and fail, as I call it. What's the test and fail? So the test and fail is really where we get the market bottom put in place. We get it put in place again, and then it spends a little bit of time underneath. Now this is a bit of a tricky one, because very often we say that if the market's holding below support, that's weak, and generally that is considered the case, which is actually why this one works so well. It's almost a failure of another pattern. So as the market's going, holding below the low, it sits there, many people are going to be pushing to short. If then it pushes back up, a lot of those shorts are going to cover, and we're going to get a little bit of push up, and it could be a catalyst to start a reversal. Now, forgetting about the shorts for a moment, why is this such a useful pattern, and what does it mean? Well, basically, if we think about what's happening here, we've got a low print, we've got a second low print, we look below that low print, we see price kind of looks around and goes, yeah, no real sellers are stepping in. You know, it sort of runs out of steam a little bit, sits there maybe for a few days, or if you're on an intraday chart, maybe it's a few hours, and just kind of looks there, and then just, you know, doesn't have any follow through. No one really considers, sellers don't consider it as value. The selling is just shut off. And at some point, the difference between that and maybe the double bottom is that buyers aren't immediately, or the exhaustion, buyers aren't immediately coming straight in. They're eventually coming around to the idea that, you know, we're not going lower. Yeah, I'll have a little nibble, and that causes us to go back up through the highs. The shorts then cover, causes the cascade, and then very often we might get the reversal. But because these are a little bit weaker type of reversals than perhaps the exhaustion or the double bottom, we might then get a retest. So one way of trading it is to wait, because very often we might also get a test up here that fails and pushes back down again. You don't want to get caught out by that. If we're looking to buy a bottom or find a bottom, then maybe waiting for the first pullback. After the drive lower, consolidate below the support, the push up, leave that, wait, pull back, pulls back to the support, then you can start to look for your buy in that position rather than a bit earlier. So you're waiting a little bit longer for a few more pieces of the puzzle to line up, and then you're buying on that, and then you're working with your stop obviously then below the low and saying, hey, if it's holding, it's holding, if it's not, it's not. Again, all the same attributes, all these good risk reward ratio if you're taking that kind of thing. All right, so fourth and final one, guys, I've got for you is the higher low. Standard classical pattern, this one. And, you know, we see this quite a lot. You know, we see a low put in, and then we see another low put in that is higher than the previous low, hence the higher low. And the distance between the two, you know, listen, you know, how close is it to a double bottom? It's going to depend. If it's much higher, of course, it's very obvious. If it's close, you might be saying, well, it's almost double bottom. What's the technicality between the two? You get the point. Doesn't really matter. But the point is that the price has hit a low, the price has pulled back up, the price has tested again, but hasn't had enough momentum to retest that low and then pushes back up. Now, the classical technicians, and those of you who read all the kind of classical technical textbooks, that's a tongue twister for you, will say, or will know, that very often you're looking to buy a move back above that high. So after the lows come in, you get the high, you get another low, and you get buy above there, and off you go, and your stop is going there. I don't have any problem with that whatsoever. The only slight issue in my eyes is that you have to have quite a wide stop, because very often it's not clean, that it might come down and retest a little bit and mess around, and so more than likely probably have to have your stop under that low. That becomes quite wide, and we know that wide stops are fine, but of course they've got to have decent targets as well to make the risk order ratio acceptable. Otherwise, it's kind of not really worth taking. You know, if you've got a 200 pip stop on your swing trade and you're only looking for 200 pips on your target, yeah, you're really not playing the game, because don't forget, you're still trying to pick a bottom ultimately, which is, you know, not a high probability trade by any means. So you want that risk order ratio to be relatively high to compensate for that. So Fine, if you can do, if you want to do that, then that's fine. Finding another way of doing it. This is my least favorite out of the four, if I'm honest, because structuring the stop or the exit, if I'm wrong, is more challenging, because you can still loiter around there and still be right, and you have to sit on a little bit of heat, and it feels like you're kind of a bit late to the party when you're buying up there. Now, if you can find, if you can kind of be a little bit more nuanced and find maybe a reversal candlestick in that 4 or 5 day cluster, you might get there on that low, then even better. Now, this is where you can start to go a little bit deeper, guys. You can start to cluster these bottoming patterns. So you could say there's your higher low, but within that higher low on that 4 or 5 days, we might see a double bottom. So in other words, we come down, we test the low, we come back up, here's our higher low, and we might kind of get a little double bottom, so to speak, in that higher low on the broader time, on the bigger time frame. So you can start to cluster these things. You might even get a little mini exhaustion, something like that. So this is where it pays to kind of be knowledgeable about these, what makes them good, what makes them bad, and how you would structure, most importantly, your stop loss position and your risk around it, and what you look for, some of the attributes of it, some of the volume, some of the range, some of the levels that are useful for the market that you're looking at the time. So anyway, guys, those are 4 times tested market bottom patterns. This video is sponsored by Core Spreads Australia. Go and check them out. There's a link to them in the description below. Take care. I'll see you in the next one. Goodbye.